Retirees hate losing money. When it comes to investing, no one really likes to lose money. Yet in my experience, I've found that retirees in particular are highly against losing money. Retirees that are at a stage in their life where they are no longer working and no longer increasing their income. They simply don't want to go back to work to make up for investment losses. And this is totally natural and quite common. Back in the early 1990s, a retiree could go to the bank and get a one-year CD paying about 6%. And during that same time, they could invest in the stock market and expect to see similar returns without too much volatility. Now, this has dramatically changed. Today, due to extended low interest rates, bank CDs aren't paying enough interest for many retirees to live on. And the stock market volatility, along with the major corrections in 2001 and 2008, have left retirees skittish about the stock market. So if retirees hate losing money, but they still want to grow their money, what options do they have? It is in this situation where indexed annuities have shown some value. Now, indexed annuities are insurance products that are purchased for two main reasons. The first is for income, and the second is for relatively safe principal growth. Now, let's discuss the growth part in detail. When you buy an indexed annuity, you are giving the insurance company your money. In exchange, they agree to pay you interest if the index you choose performs positively. An index like the S&P 500 is only a way to measure interest. You don't own the index yourself. So if the index goes up, your account is probably credited interest. I say probably because there are limitations on the interest that is credited, which I'll get back to in a moment. In the opposite scenario, when the index you choose goes down, you get zero interest. Your account value doesn't go down due to the index going down. You simply are credited with 0%, even if the index is down 20%. So if the index goes up, you may gain interest, but if the index goes down, you get zero. That seems a little too good to be true, right? In reality, this is why indexed annuities are so popular for retirees. There is upside potential without any downside market risk. So what's the catch? There are a few that I want to highlight to you right now. Now, remember how I said there are limitations on the interest credited? These come in a few ways known as caps, spreads, and participation rates. These are stipulations within the annuity contract that reduce the upside from what you would get if you actually own the index. It's important that you understand these limitations when considering an indexed annuity. Don't gloss over these interest limitations, even if the index you are considering is said to be uncapped. Also, there are surrender charges associated with indexed annuities. This is a fee you pay if you withdraw your money from the annuity contract during the surrender period, which usually lasts between 7 to 10 years. Finally, these insurance contracts are between you and the insurance company. The guarantees of the contract are only as good as the claims paying ability of the insurance company you choose to work with. So when people say to me, "Dan, I hate losing money," I'll often introduce them to indexed annuities. They tend to appeal to the conservative investors and are sometimes worth considering as you approach retirement. Just be sure to work with a company like Dolphin Financial Group that represents multiple insurance carriers and can review the pros and cons of the options that are out there. Indexed annuities can be confusing, but don't let that stop you from learning about these conservative options for your retirement funds. Contact Dolphin Financial Group to learn more.